The best experience I had, bar none, was working with Les Rosenthal. I have the fondest memories of that. There are great stories of Les. Les, is a controversial figure like most of the powerful leaders were. I treated him fairly. He treated me fairly. And I had fun working with him. He did things that, in retrospect, I still laugh at. Um, One day after the crash of '87, he and I would meet at 4 a.m. And the reason we met at 4 a.m. was because it was the only quiet time we had. And we could go through the condition of the firm, my trading program, and whatever else we needed to manage for the day. And he would show up at 4. I would show up at 4, sometimes a little earlier. And every time we did, the phone would ring. And I'd pick it up, and it was his wife. And she would go, "Hi, Gil, is Les there?" And I'd say, "Sure, Harriet, wait a minute." And I'd get him, and she was checking to make sure, because he's walking out the door at 4 a.m. And where are you going? I'm going to meet Gil at the office. Um, and things like that. And during that period, I came in one time, and he had been there for at least 2 hours. And I look at bonds, and they're just about limit down in London. And he says to me, "What's going on with bonds?" And I said, "I have no idea, Les. I just walked in the door." And we're watching, and they're just sitting there almost limit down. And comes time for the Board of Trade to open. And he says, "Call the floor and see if you can tell me what's going on with bonds." So I call the floor, and I ask one of our brokers, and he says, "Nobody knows, just massive selling in London, massive selling in London." I said, "Well, what are they called?" And he says, "Almost down the limit." So I said to Les, "They're almost called down the limit." So he says, "Let's go to the floor." So I go to the floor with Les, and we're on the edge of the bond pit. And he says, "See if they're still called down, almost down limit." And I said, "Yeah, they're almost called down limit." He says, "Do you think I should take them in?" And I said, "What do you mean?" He says, "Well, I couldn't sleep. So I came to the office, and, I was kind of annoyed. And I started pushing the bonds around, and they started to break. So I sold more." He was the guy that broke them in London. And he bought them in almost limit down. I assume he made money. He never said. I never asked. So I have a lot of stories about, things like that with him. Some of the camaraderie was very enjoyable. As I said, people took care of each other. It was a good place. It was a good place to be, particularly for me, the Board of Trade. I just liked that exchange of the three in Chicago. I was active on the best. The American Stock Exchange had antics that you could never do on the floor of the exchanges in Chicago, that no one would have tolerated it. You had a guy who thought it was funny to walk around with a mirror, pushing it on the floor to upskirt the girls. These days, that would put him in jail. You had the games they played with brokers and clerks. With clerks, I can't tell you how many clerks we had running around moments before the opening looking for the key to the clearinghouse. And we would tell them we couldn't open the stock without the key to the clearinghouse because we couldn't input any trades. We needed the key, and nobody knew where the key was. And you'd send them to this specialist and that specialist. You'd send them over to the COMEX. Everybody was in on it except the clerk. There was a game called Find the Odd Lot Stretcher. What's an odd lot stretcher? I have no idea. But we sent clerks to look for it. And the idea was an odd lot, of course, was less than 100 shares of stock. And you would tell people that they were hard. You'd tell the clerk they were hard to trade unless you could stretch them. And there was a special odd lot stretcher. And the clerks would run around looking for the odd lot stretcher. We would send them all over Lower Manhattan looking for that. For the brokers, again, on the Amex that you couldn't do in Chicago, you'd see a thing go across the tape, as I remember it, and maybe some of the details are off because of time, but you would see WO for the stock symbol, indication only, and they would put out an indication in a stock. Well, WO stood for Western Oxygen. Western Oxygen did not exist as a stock. It was completely fictitious. And what people on the floor knew was that there was a green broker that was about to get baptized by fire. And what would happen is a few minutes would go by, and on the designated specialist post of the day, a crowd would gather, trading WO. and you had 24 people trading this, and the broker's clerks would be in on it, one of the firms, and they would give the guy an order. And the crowd was designed so that it was very hard for him to get anywhere near the specialist. And he would do some orders and do some more orders. And finally, they'd give him a huge order, buy 100,000 shares at the market. And the crowd knew it was coming, right? So they would let him in, and he would buy 100,000 shares. The stock would just soar. And then he would go back to his clerk and give him the clerk the order. And he said, you bought? I said, sell. And the guy would run back to the crowd trying to get out of it. No one would let him in. And by the end of Western Oxygen trading, he would have some huge loss. And what they would do at that moment, when he was probably thinking of where's my pistol, they would rip his collar off, and they would give him a gift certificate for a custom-made shirt. Well, you couldn't do that in Chicago. I don't think anyone would stand for it. And, nowadays that would be illegal too, but they did things like that. And there were a whole lot of other things, a whole lot more crude, again, that you couldn't. Well, the day I told you about where I had lost 25% of my capital, which was that was, again, it wasn't the loss. And ultimately it was a good day because it was transformative of me as a trader. I began to understand options spreading, and I became very, very good after that. That is probably the worst trading memory. The crash of 87 was very, very stressful, but it's not my worst memory. We had one trader who lost a lot of money. We had traders who made decent money, but it was incredibly stressful. In that sense, it's an unpleasant day. But at the same time, it was very revelatory of character. On that day, it was like God had opened the window to men's souls and women's souls on the floor, and you knew more about people quickly in that mess than you ever knew about them before. That was pretty bad. The singularly most unpleasant event for me came because of my involvement in the political structure at the Board of Trade. The governance structure and the product design structure. I was the chairman of the swaps subcommittee of product development. I launched the first swaps contracts on the Board of Trade floor, the 3 and 5 year swaps. And as part of CFTC reauthorization, the executive committee of the Board of Trade asked me if I could put together a swaps clearinghouse, because they wanted to use the Board of Trade developing a swaps clearinghouse for political leverage. And I was led to believe at the time as a business venture. And I said to them, okay, I'll do that. And they said, we want it to be completely secret. You're going to have a committee. You won't be on any of the committee meeting boards. Everyone on the committee was sworn to secrecy. And I went about meeting with key players. I met with Paul Volcker. I met with William Seidman from Resolution Trust Corporation, met with Fannie Mae, Freddie Mac, the senior leadership at the World Bank, AIG, which was one of the major swap players at the time, trying to put together the support for a clearinghouse. And I was quite successful at finding that support. Volcker couldn't. He had a conflict of interest, he said, but the other people were on board for it. And I was putting together an industry advisory board. And at a certain point, it both leaked and it was time to go public, because you can't convene an industry-wide meeting without it going public anyway. And word leaked of what I had been doing. I did not know the degree to which Goldman Sachs was opposed to what I was doing. And they had Billy O'Connor's ear, who was chairman at the time. The chairman of the Clearing Corp at the time was opposed to it. He thought it would destroy the exchange. So even though he was on my committee, he was sandbagging me in his spare time. And some very powerful traders and political people who, some of them had very large egos. Others thought that any press release that didn't involve them was not a press release at all. And the next thing I knew, I was hung out to dry. They just essentially made it look like I had been fired, gave the project to some other traders, and it fizzled out because for reasons I'm not wholly sure of. And the Billy O'Connor refused to meet with me after that. He wouldn't talk to me. Just got hung out to dry. I still to this day don't fully understand what happened, but the damage to me was not just at the Board of Trade. It was to my contacts in the cash market, because they made it look like I had been fired. So people I was talking to were reluctant to talk to me because they didn't know what was going on. One asked me, I said, I have no idea. Well, that's believable, isn't it? You go from project head to outcast and you don't know why. That was a very bad day. At the time, I was backing Pat Arbor for chairman. And so I guess it would be between 1992 and 1993. He became chairman in 93, I think. I thought he was the best man for the job, and it turned out maybe to be right because he was chairman for 6 years. And after he was elected, I went the next day or day after to congratulate him, and he says to me, "Well, what do you want? What committees do you want?" and things like that. And I looked at him, and I had never even thought about what I wanted. And I looked at him, and I realized I didn't want anything anymore at the Board of Trade from a political point of view. And I said to him, "Nothing, Pat, really nothing." He says, "What do you mean nothing?" Right? Like Pat's a politician. You helped me, you supported me, you got me elected. What do you mean you don't want anything? Right? And I said, "Well, I think what I'm doing is going to Europe. I'm going to lease out my seat and go to Europe," which is what I did. One door closed, other doors opened. And it was a transformation of my career to get off the floor. And I never stopped trading. I kept my memberships until 2012. But I stopped being involved in the political process at the Board of Trade. And I had started before that, I decided to leave the floor. It was just a question of how, because every morning I'd go to breakfast and the same guys from the corn pit were sitting at this big table. And the conversation seemed like every day it was the same. "I hate this place. I'm tired of doing this. I'm stuck because of my kids and college, mortgage, whatever." And I said, "I don't want to be that way." So I went to Tony Saliba's group. He was running a thing called the International Trading Institute. And I said, "I want to teach." They couldn't figure out why me, Gilbert Leistner, was coming to them to teach. They figured I must have had some secret debit that was chasing me from somewhere, because they couldn't imagine why I would go from what I was known for to working with him. But I did, and there was no debit chasing me. And that opened up tremendous doors for me. I taught all over the world with Tony, either directly by being there or sometimes at a distance, like I did with guys in Australia. I did programs for Japan, trained all the, like 20 product managers, senior managers at UBS, did forensic work for UBS when they had this big option debacle because they didn't have good risk control. And not the way you think. I mean, most people think of that. They didn't manage Delta. They didn't manage Gamma or Theta or something like that. That wasn't it. They had limits on guys. But what they didn't anticipate is somebody would have a hunch and want to bet a bunch, and he couldn't do it through the electronic system or any other way because of their controls. So what he did is he did an over-the-counter trade inside the bank with another department and wound up short tens of thousands of DAX puts. And the DAX went down. And of course, one day the phone rings between two managers, one on the long side of the put trade, calling the guy who doesn't even know he's short DAX puts yet. And he says to him, "We're looking for some money on this DAX trade." And he says, "What DAX trade?" And they found out that they had no mechanism within the bank for controlling that kind of option risk. Cost some directors their directorships and so on. So I did that. Tony's group got me to that. I helped Croatia start up UTAB in Austria, and so on. And then I started consulting on my own. When I was living in Paris, my friend Neil from Merrill that I mentioned earlier called me up and said, "Hey, I got a memo here that the American embassy is looking for a commodities trader that speaks French." He says, "Know anybody?" I said, "Oh, yeah, I think I do. It could be me." So I went to the embassy and I became part of the speakers program there, as they called it. And my job to start with was to follow behind President Clinton and Robert Rubin when they went to African countries and made promises to help them implement these capital market programs. That led to me helping Ghana and Cote d'Ivoire tried to put together a cash cocoa exchange. It fell apart because of a coup in Cote d'Ivoire. It never quite recovered. I hope the Ethiopians relaunch commodities and stocks. Stocks took a long time in Ethiopia. They did commodities first. Kenya, I helped build capital markets and things like that. That was a hoot. I really enjoyed that. I wouldn't trade that stuff for anything. Twofold. One is you had a speculative one, and then you had one that was based on structure. And as options matured and the dominant players began pricing things to theoretical very aggressively, it favored taking risk because your outs were perfectly priced, right? We started out trading a lot of, reversals and conversions, either by legging into them or by doing them outright as we could. And, those were, except for pin risk, very, very profitable if you did enough of them. The thinking trader I mentioned, a fellow named Ed Lees, was very, very good at creating structure in the S&P options. He made consistent money. I had a few gunslingers, which I tolerated for a while, but didn't want the stress because what I was interested in was sleeping at night. And that ultimately, the globalization, the night trading, and the overnights ultimately led me to tell Les I didn't want to run the program anymore. And it was kind of like this. One night, the phone would ring, right? And I could tell from the satellite chirp whether it was Singapore or London, because they had different chirps when the connection got made. And I hear the chirp, and it's like 3 o'clock in the morning, and I know it's Singapore. And I'm groggy because it's 3 o'clock in the morning, and the broker in Singapore says to me, "Hello, Gil, it's Lawrence Ho." I said, "Who?" He said, "No, Ho." And he said, "No, Lawrence Ho, your man in Singapore." And then he proceeded to tell me how Murazawa, which I think is the correct name for the Japanese finance minister at the time, had said this, that, and the other thing. All our euro spreads were out of whack. What did I want to do? And I basically said to him, let's start putting them in line or adding to them, because I wasn't going to liquidate them. And I didn't want that. And I was at the point where I had to make a decision where we were either going to take it to where we started hiring people to run it around the clock, or did I want to not do that? And I made the decision I did not want to do that. The best day was after I understood spreading and how to protect myself. I developed, because of that horrible day I mentioned, I started to look at my risk profile more standard deviations out than anybody else, I think, at the time, because most people look 3 standard deviations for 99% of the moves. I looked 6. I looked 8. I would look at what happens if the stock goes to 0 or 500, right? What would I look like to know whether or not I was in business? And I started building my downside protections, which I paid for month in, month out, because most of the time you didn't use it. And there was some bad news in the position I had, and the put structures I had, whether synthetic or actual, kept me from losing $500,000. I made $50,000 on the day, on the open, all because of the put structures. That to me was my best day. That wasn't my most profitable day. It was my best day. The evolution of my trading really is the evolution of the options industry, because when I started, puts had, a couple of months after I hit the floor, listed puts came along. And they existed in Chicago a little bit, but the SEC embraced them. The Amex started trading them. And at that time, as you know, and I told you I bought this 5-point spread for like a 16th credit. The reason for that is the traders on the American Stock Exchange floor traded each individual option like it was its own stock. They had no idea the theoretical relationships between them. This created distortions that became extremely profitable. At the time, also, you had interest rates rising up through 13% at that point, as I recall, as Volcker was on his way to raising them to 20. And synthetic puts went begging. I remember in U.S. Steel buying puts in eighth over and for parity, synthetic puts. I would buy in the money calls and sell the stock for parity. And I did this so many times all over the floor, so large, my accountant, when he did my taxes, says to me, please explain to me how you've earned all this interest, because he couldn't believe the number. And those things existed and then gradually disappeared because, I wasn't alone in seeing them. Um, Reversals and conversions were mispriced. People didn't understand them, and they would run up the puts when the stock went down, and they would drive down the calls when the stock went down, and run up the calls when the stock went up, and created enormous distortions. At that time, we had on the floor a terminal called the bridge terminal, which was the first options calculator I had seen. Some mainframe somewhere, and we had a dumb terminal, right? Not a completely dumb terminal. You could change parameters. And there was a trader there named Hayes Knoll and another one named Bill DeCamp. And we noticed something peculiar. At that time, I don't remember whether it was Myron Scholes, Fisher Black, or both of them together, were selling to the floor sheets on how to value options. We got them once a month, right? And it showed what the daily decay should be. It showed the delta and everything else. So we'd have this sheet that says this option is worth 2 15/16, right? And you'd go in the crowd and it's trading for 3.5. And, or, the converse, sometimes they were too cheap. And we said, how can this be? Well, the thing about it was the way you priced options, if you didn't have a Black-Scholes model in hand, was you sold it, you raised your offer, you raised your bid. They took your offer, you raised your offer, you raised your bid until you found the equilibrium point. That was fair value when the buying and selling pretty much was not in an imbalance. And that for the option would be, 3.5. We'd look at the volatility on the bridge machine and we'd say, but the vol is 12 historically, and the option's 3.5. And we figured out the idea of implied volatility by solving backwards from the options price to determine the volatility. And that to me was a major breakthrough because it showed me again, even before I knew about Rumpelsnitz, that the options model had a problem. And it was ultimately subject to buying and selling pressure. And the implied volatility took me down the journey of classical probability versus Bayesian or expectational probability. The implied volatility is expectational. The Black-Scholes model gave you the historical volatility. And over time, people began to understand implied. But again, you could do reversals and conversions for monopoly rents. And that was part of it. Other things that existed is you had no fungibility between Chicago Clearing Corp and the New York Clearinghouse. So an option listed on Chicago did not cancel out. So if I bought an option in Chicago and sold it in New York, I carried those positions till expiration day, unless I unwound them. And at the time also, again, an artificial structure is the floor managers would decide which the dominant exchange was. So in Bally options, it was Chicago. In other options, it was New York. And I would buy options in Chicago and trade them in New York. Those were things I did. As things became more structured and O'Connor and Associates began to make a strong presence, things started to move more towards theoretical because they had the big computers and they had the big money. And about that time, one of the traders in Mesa Petroleum, a man named Stanley Katz, invited me to dinner because he had his own sheets and his own model. And he had, I think, what was at the time an Altair computer. And before dinner, he's programming the Altair. He's flipping little switches, right? And waiting for the options to come out. And he says, "You are?" And I said, "Yeah." I said, well, where's the output?" He says, "We'll come back after we have dessert." And this little tiny computer is chugging along while we're eating dinner, and he spit out some sheets, and he introduced me to computers. I had nothing about PC type computers until I met him. And that also transformed my trading. When I went to Chicago, bond options were just starting. So again, there were lots of inefficiencies. But again, you had more sophisticated big capital people to help put it in line, but there was still plenty of mispricing opportunity that existed at that time. CRT began to dominate the pit. They went through a period where they priced all the reversals and conversions, I think, for no money so that they could try and force locals out. Worked to a point. And that's when I said, well, if they're perfectly pricing everything for no profit, then the only thing to do is create risk structures off of their pricing, which is what I did. And that worked out very, very well. So my trading style changed that way in terms of market making and managing my group. Myself, I always lean towards measured risk. And I mean measured in two ways. One is knowing what my downside is, trying to estimate the upside. The downside is always more important than the upside. And trying to find new information. And as an example, in beans one summer, I was having a debate with this guy from the University of Chicago who thought he knew how to trade. And he told me my long wing positions were going to do nothing but cost me money. And I let him tell me how I was wrong on everything. What I didn't talk to him about was, so you had a distribution that was very narrow. You had the wings were very cheap and everything was clustered in the middle. What he didn't know is what I knew. I knew how to read weather maps. And the Chicago Board of Trade posted weather maps on the floor every day. And you could read the weather maps if you knew how to do it. And what I saw coming was a drought. You could see it from the way the high pressures were situating over Canada and over the Midwest. And what I knew for sure is beans were not going to be quiet anymore. I was absolutely certain. So I structured my position that way. That's a risk position with a known risk, a known downside, and where I believe the odds went in my favor. So I like that kind of speculation a lot. I still do it.